So guys, we are done with our time value of money concepts. Now next aspect we will discuss is in this section B we are going to start, sir. In that, if security valuation is what we are going to do. So that security valuation, even though it looks very small, it is basically two different chapters again. One is a concept called as bond valuations. Then there is a concept called as equity shares valuation. How to identify the worth of a bond, how to identify the worth of a equity share. This itself is two different chapters actually. After doing these two, probably we will be doing mutual funds, and once mutual funds is over, we will hit the main chapter which is called as portfolio management. These three chapters put together are called as portfolio management. Last one, efficient market hypothesis, small technical analysis case, that we will see towards the end. That's easy only. So all in all, if you check the weightage, 35%. If you carefully listen to the concepts, practice the questions, 35 marks is like you already have it even before going to the exam. It will be that simple, but conceptually it should be good. Okay, anyway, without any further ado, we'll start off, sir. We'll start now with our discussion on bonds. So under security valuation, you have equity and bonds. In that, presently we are starting bond valuation. Actually, bond valuation is such a big chapter, like the concepts, there is no end. It's like very, very huge chapter. But luckily for you, in our syllabus, the content that is there, the coverage that is there is not vast. It is limited. So that makes this chapter a little more bearable actually than what actually it is. Anyway, now you tell me, sir, what is the meaning of a word bond? What is the meaning of the word bond? Bond basically is nothing but, sir, do you know the word debenture? Tell me what is the meaning of debenture? It's a debt instrument issued by the entity for raising money. Just like how company takes loan from a bank, which we call it as a term loan, like that, if company takes loan from various people by issuing instruments like equity shares, these instruments, they don't give them ownership, they give them a right to claim the money back along with interest. The debt instrument, that security, is called as a debenture, and it debenture a bond. Technically, there is no difference between debenture and bond. When we say bond valuation, we are talking about debentures ka valuation. Now, next point. Sir, when debenture and bond both are same, why to call it as bond valuation? Let's call it as debenture valuation only. Call it, no problem. Only one small difference is there, sir. Now, debt instruments issued by company for raising funds. Debt instruments issued by the company for raising funds called as debentures if issuer entity is a company, and they are called usually as bonds if issuer entity is government or public sector undertaking. If for general understanding, I am telling you, sir, but as such, these terms are used interchangeably. These terms are used interchangeably. There is no fixed rule and also the general understanding I'm telling you, but as such in the questions, you will see the word debenture also, you will see the word bond also interchangeably, we can happily use of. There is no problem in that. Now, come here, sir. Imagine this is balance sheet of a company XYZ Limited. XYZ Limited wants money. So what they have done, they have taken money from a bank, 12% term loan from ICICI Bank. Some 100 crores they have taken. Now, in a term loan, typically what will happen is the company has to pay interest every year, and one day they have to also repay the principal amount. Correct? So who lent money? ICICI Bank. So the investor is only one person called as ICICI, the lender, and you are the borrower. Our company is the borrower. Investor is who? Single party called ICICI Bank. This is one borrowing. Look at another borrowing now. In another borrowing, the company issued 10% debentures and raised 300 crores. Now 10% debentures the company has issued a security, and some people have invested money in this. Now who are these people? Let's see here. These people are investors who wants to earn some interest income from the company. So they supplied money to the company, and company gave them debentures. Investors of debentures or bonds. Now, company raised money. If you take one fellow and zoom in, bond or debenture, and in this debenture what will be written is they will identify something called as face value or par value of the bond. Let's say in my example it is 100. It can be 100, it can be 10 rupees, it can be 1000, 10,000, 1 lakh, it can be anything, sir. That's company's wish. And along with the face value, they will identify something called as coupon rate, which is also called as interest rate. But careful, sir, don't use the word interest rate, call it as coupon rate only, because interest rate is generally supposed to mean the running interest rate in the market. Coupon rate is supposed to mean the interest rate that is fixed in the contract between investor and the company. So both are interest rate only. So to differentiate, we are calling this as coupon. Interest rate means general interest rate in the market. So coupon rate is, let's say, 10%. Maturity 5 years. Randomly I'm writing some numbers, okay? What is the meaning of this? What is the meaning of this? The meaning of what we have written is the bond is redeemable at 5 years or at 5th year. Each year coupon amount they will pay. How much coupon amount they will pay? 10%. 10% you have to apply on what? Face value or par value, that into coupon rate. So in our example, that is 100 into 10%, which is equal to 10 rupees. Now, at the end of 5th year, the bond can be redeemed at par or premium or discount. That depends on the agreement between the company and the investors. If the company says they'll redeem at par, they'll redeem at par. Premium, discount, it's all matter of agreement between both the parties. Here one note point what you have to remember is, if question is silent, what will you assume? Obviously, you don't have a choice, no sir. If you assume that it is redeemable at premium, how much premium? You do not know. If you assume that it's redeemable at discount, you don't know how much is the discount as well. So you don't have a choice basically. The question is silent. Assume bonds are redeemable at par value. Par value, face value, nominal value, all are same. They're all different names. Par value, nominal value, face value, they're all the same. Right? Next. Now, sir, general question. This investor, with a lot of josh, he paid money to the company, purchased one bond, and nicely he is receiving interest. 1 year he received, 2 years he received. Third year, sir, this fellow is in urgent need of money. He went to this company, told company, I gave you money, you owe me money, take this bond, pay back my money. Will the company pay? What will the company say? Ray, come here. What is the maturity period? 5 years. So you can't ask repayment before that date. So you have given me money, I will give you definitely after 5th year, not before that. Sir, but this fellow is in urgent need of money. How will he get? Company will not give. Next. Another case. The company issued the bonds. The offer was open for a period of 15 days. Whoever applied, they got allotment. They all became bond holders of this company. You were sleeping at that time. You got up. You saw, wow, fantastic interest rate. I also should invest. You went. That fellow says, sir, issue date is over. We already issued, allotted also. Issue is closed. We can't give you. Your ego got hurt. How can you say no to me? I'll pay extra. Give me a bond. Take money. I'm giving you money. Take, buy whatever you want. Give me one bond. Company says no. I issued bonds. Offer was open for some time. You did not come at that time. Now I will not offer any bonds to you. That means existing investor cannot get out if he wants to sell the bond. New investor cannot enter. Correct? So there is a problem of liquidity now. A liquidity problem, how they will solve is, they will get these bonds listed on stock exchange. After the bonds are issued, bonds are listed on stock exchange. Now here, this company issuing bond to the investors for the first time, this is called as primary market. This entire thing, whatever we are studying, we are discussing till now, this is referred as primary market. In primary market, what happens? Company issues security, let it be share, let it be bond, directly to investors. And investor is also buying bond from whom? From the company. Correct? This is primary market. Now, to create liquidity, issuer entity may list the bonds on stock exchange. What will happen if you list the bonds on stock exchange? It creates a market now. And thus provides liquidity. What is the meaning of the word liquidity? Ability to convert anything into cash. An existing investor who wants his money back, he can't go to the company and ask money, but he can sell this bond to some other investor. So who will pay money to him? Some other new investor will pay money to him. He will exit. Our place, this fellow will go and sit, the new guy. Are you getting it, sir? Company will pay interest to whoever is the owner of the bond, not to the same person who purchased it on the first day. Whoever is the owner of the bond, that fellow will get the interest on the due dates. Right? So this creates a liquidity. Sir, is secondary market, stock exchange and all is nothing but it's second hand market, sir. You want to buy a car, you can buy in two places. One, directly from the showroom, the primary market, or from some other existing owner of the car. This is called a second hand market. The secondary market is that. Primary market means directly from the issuer, first time when you buy, no, that is called as primary market. Once already company issued, I issued securities trading in the market stock exchange, you go and try to buy that, that is called as secondary market. Clear, sir? Now, in this chapter, predominantly we will think from investor's point of view. Say 99% of the questions are from investor angle, not from company's angle. So tell me, bond is an asset or liability? It depends on for whom. For the company it is a liability, for the investor it is an asset. Now, the entire chapter is constructed in such a way that we do most of the analysis from investor point of view. Of course, company also we will analyze, but mostly it will be from investor's angle. Okay, next. So what is the meaning of bond valuation? Bond valuation is nothing but determining the fair value of the bond. You identifying the fair value of the bond is called as bond valuation. Sir, what is the meaning of fair value? It is the ideal price at which investor should buy the bond to earn his required return. So in order to earn his desired rate of return, how much should he pay ideally? That is called as fair value. Also called as intrinsic value, equilibrium value, theoretical value, that's all. These are the names of bond value. So if the question asks you intrinsic value, theoretical value, fair value, everything is same. All you have to do is apply one small formula and get the value of the bond. That's it. Now, coming to what is that logic? How to compute the fair value of the bond? Very simple. Fair value of the bond is nothing but take the present value of future cash inflows. What are the future cash inflows from the bond? PV of, tell me sir, bond gives you what cash flows? Coupons, that is present value of coupons plus towards the end of the period you will get redeemable value also, that we call it as maturity value. Present value of maturity amount or redeemable value. Now whenever you use the word present value, you are duty bound to ask me and think for yourself also what discounting rate I should use. Discounted at, make no mistake, let it be capital budgeting, let it be derivatives, let it be bonds, let it be shares, let it be business valuation, let it be any valuation. From an investor angle, if you are doing by default fix off, your discounting rate is required return. Your discounting rate is nothing but required return. On the other class, when we were discussing NPV concept, who was making investment in the machinery? Company was making a, investor is making a, company, not equity shareholder. No, equity shareholder invested money in company. Company is trying to buy the machine. So who is doing the project evaluation? Company. So company point of view required return. Here, who is buying bond? Investor. Investor point of view required return. All whoever is putting money, that fellow I will ask, Babu, how much required return do you want? I want 80%. Sir. Not like that. A required return ki one calculation is there. Simply wishful thinking is not required return. Required return ki logic is there. If you take some stupid dummy number, how will you get fair value? A required return also some logic should be there. So the ideal correct required return of the investor must always be used as discounting rate in order to obtain the fair value of the bond. Clear? Now, so which means it is something like this. Imagine, sir, you are having cash flows like this. There is a coupon amount here, there is a coupon amount here, coupon amount here, coupon amount here, plus you are also having a maturity value. Your goal is to work out the fair value of the bond. Based on the above discussion, what is the answer? It's present value of all your future cash flows. That means I have to discount what all, you tell me? I have to discount present value of all these 4 coupons. I have to also discount the maturity value also. That means the entire coupons ka present value and the maturity ka present value. So let me write like this. Is it correct? Now next question is what is the discounting rate? That already be identified. Discounted at what rate? Required return of the investor. Now, this pictorial formats just to make you understand where the cash flows are, where you are dragging it and all. Formula model if I write, it will become even more cheap. Look at this. Fair value of the bond is equal to coupon. How many coupons are there? 4 coupons. Every year interest amount is same, no? Therefore, there is an annuity cash flow only. Since that is an annuity cash flow, take one annuity cash flow and multiply with what? PVIFA required return 4 years in the above example plus. Tell me, sir, a maturity value comes every year, only once? Only once. So that's a single period cash flow only. So take the maturity value and multiply that with PVIF RR 4th year. That's all. Over one line la answer is ready. This you should have in your mind. This should be on paper. Initially I'll do both, but over a period you should know how to think on timelines. A timeline, if you understand, SFM will become very easy for you. Am I clear till here? Now, Now, nobody will have any doubt about these numbers because they are matter of agreement between the company and the investor. A bond ka terms, they will tell you how much is a coupon rate, how much is a maturity value, and that is not something which is estimated or something. It's a matter of fact. That's not dividend, no. Dividend may come. No, coupon, pakka it will come. How much it will come, I know already. Stated interest rate, everything is there. Now, how to compute or how to identify required return? Required return is based on two things. Market interest rate, that is risk free rate, not only that, and also the riskiness of the borrower. Sir, Reliance company is issuing bonds. You went and purchased that. So who is investor, who is borrower there? You are the investor because you are paying money. Who is taking money? Reliance. So Reliance is the borrower. Now how risky the borrower is, depending on that you want some extra return also. Now, high risk. If it is high risk, then you want high required return. Low risk, low required return. No risk, then you don't want any extra return, but definitely you want your risk free return, RF. This is what you will expect. Okay. Now, how will you know the risk of a company? If a company is issuing bonds, whether it is risky or not, or if it is risky, how risky it is, how will you know? Risk of issuer company is identified by its credit rating. Sir, what is credit rating? Credit rating means, sir, for example, if you are an auditor, what is your ultimate job as an auditor? To express an opinion, whether things are correct or not, whether things are reflecting a true and fair view or not. So, as an auditor, your obligation is to express an opinion. Like that, debt issuing companies, for example, I'm a company, I want to issue bonds. If I want to issue bonds, public don't know about me, no. So how risky I am, public do not know. So what I'm supposed to do is, I have to go to an independent authority like CRISIL, Standard & Poor, Fitch Ratings, CARE, these kind of companies are there, who are individual rating companies. Go there, furnish all your past history of borrowings, how you have repaid them and all, what are the current assets, liabilities, what you are having, what kind of projects and what kind of businesses you are doing, all that if you explain, that fellow will see all your history, your present position, forecasted position, and then he will express an opinion that a company is less risky, moderately risky, high risky, some opinion he will express. Based on that opinion, the investor will understand how risky it is. Okay. So, for example, if you're getting a rating of AAA, what it means is absolutely safe investment. AA, little safe only, but risk. Like that, single A, triple B, double B, like that it goes on. Sir, up to what level? Z is also there. Z means invest at your own risk. Like how bonds have ratings now, countries also will have rating. India entirely as an investment place, it has got certain rating. India investment. How much risk Indian country is for investment? Pakistan, Z. I'm not joking. It's not like our hate for Pakistan. Nothing like that. The rating is Z. Meaning what? Invest there. If you get, you get. Otherwise, you have to forget it. Either you'll get back your money or you'll get back a bomb. So, something like that. See, financially duped countries, sir. They don't have money, they are begging. That country as a whole, they are unable to repay their existing loans only. If somebody wants to go and volunteer and give, at your own risk, you can do that. Nobody gives money to Pakistan. That's why they are borrowing from IMF. Where they are a member, they have a right to borrow, they are borrowing. So other countries and all won't lend any money to Pakistan because they don't have capability to repay the loan. Worst capability. A bad rating. India rating was under below B. Last 10 years this government, it improved. It's not very great now, but it is relatively better. So lower the rating, higher the risk. Higher the risk, higher the required return. Like that it depends. Okay, now. Look at this, sir. For example, let me take 3 bonds. All bonds have common features, sir. First, the bond has a maturity of only 1 year. Sir, maturity 5 years you can take. No, 1 year I will take. It's easy to handle. And at the end of 1 year, they will give you 1000 rupees inflow. Your job is to tell me how much is the fair value of the bond today. What is fair value of the bond? That's nothing but present value of the 1000 rupees only, correct? Discounted at required rate of return. Now, case 1. Bonds are issued by Government of India. If Government of India is issuing the bond, riskiya. Ours is not Pakistan government, no sir, Indian government only, RBI is strong only, capable of repaying your money even if you give also. So, it is a risk-free investment. Tell me, if it is a risk-free investment, how much return will you expect? Risk-free rate only. So, required return is equal to, let us say, 6%. Which is nothing but the risk-free rate. So value of the bond, how much will you give today? 1000 rupees divided by 1.06. You can multiply with PV factor also. Single cash flow directly I am doing. How much is ma? How much did you get? 943.39. Okay, 943 will make. That's okay. What are you trying to say there is, I am giving money to you, government. You are not risky. Since you are not risky, I don't want any extra return. I just want risk-free return. Since I want risk-free return of 6%, if I invest 943 rupees in you, on 943, if I earn a 6%, 943 into 6%, if you check, it will be exactly equal to 57 rupees. 943 plus 57 will be my 1000 rupees. I will recover it after 1 year. This is what you are saying as an investor. Case 2. Bonds are issued by Reliance Industries. Tell me, sir, Reliance Industry is risk-free investment, risky investment? Reliance is government ka friend, not government itself, no. And you know what happened to second Ambani? First Ambani, lot of money. Second Ambani ka credit rating, very bad. Lot of defaults. Company worst position. Just because name is Ambani, you should not go and invest there. Should be careful. Sir, nobody is noble in real life. They are all limited liability companies for a reason. Ambani is the face of it. But you are not giving money to Ambani, no, you are giving money to Reliance Industries. People scold Vijay Mallya. That fellow never suffered loss. A company suffered loss. Kingfisher Airlines suffered loss. He is having money. But out of noble, even though my company is in losses, I will come and repay the loan of SBI, and he will tell. No. You will not, promoter is a face, but ultimately you are giving money not to the promoter, to the company. And company, it is limited liability entity. Okay. Now, this is definitely risky company. So, risky investment. What is your required return? You want certain risk-free rate surely, plus some extra return for the risk. The extra return for the risk only, we actually call it as risk premium. Let us say that works out to 10%. So 4% extra return is what this investor is expecting. Tell me now, what's the value of the bond? 1000 rupees divided by 1 plus 0.10. 909.09. Okay, 10 will make. Closely observe. Both the bonds are giving you same amount after 1 year. But in the first bond you are investing only you're investing 943, but in the second bond you are investing only 909. Both the bonds will give you same cash flow, same maturity, everything is same. Only difference is issuer company ka risk. First entity no risk, second entity risk is there. Now that risk is there, you want more return. Since you want more return, you are investing a lower amount. Cash flows are fixed. If you want more return, there is only one way of earning more return. What is that? Invest less. That's what it is. Next, case 3. Bonds are issued by some ABC Limited, which is newly formed. Since it is a newly formed, it's very risky than Reliance Industries. Therefore, your required return is equal to 14%. Sir, all our assumptions only. I'm just telling you some proofs, that's all. Therefore, value of the bond is equal to 1000 divided by 1 plus 0.14. 877. 871 now? 7 now? Okay, fine. 877. So guys, 877 rupees you will give. You see, all the 3 investments after 1 year you will get what? 1000. But the amount what you are giving today is not same. First case you are giving 943. Second case you are giving 910 rupees roughly. Third case you are giving 877. Why? Because even though the cash flows are same, the risks are not same. Since the risks are not same, your desired returns are not same. Since your returns are not same, your investment is also not same. Are you understanding what I am trying to say, sir? So, more risky, investor will expect more return. That's all. So, this is the background of bonds. Now, tell me this. Okay, summary. Fair value of coupon paying bond. Fair value of coupon paying bond is, we already discussed this. Take the coupon amount, multiply it with PVIFA for n periods, plus maturity value into PVIF. This will come only once. Correct, no sir? This is coupon paying bond. Next one. Zero coupon bond. Zero coupon bond means the coupon rate is 0%. The company will not pay you any interest at all. Sir, when the company does not pay any interest, why the hell will I invest in that company in the first place? That's all. A bond is issued at discount, redeemed at par. So a difference, whatever is there, a difference is your interest income. Every year you won't get, at once you will get. So in zero coupon bond, the bonds are issued at discount. And redeemed at higher value in future. On maturity date. There will be no intermediate coupon cash flows. It will be like this: 0, 5 years, first year, second year, third year, fourth year, nothing you will get. Fifth year, directly you will get the maturity value. Let's say maturity value is 100. Tell me, sir, what's the fair value of the bond? All you have to do is what? Discount only one cash flow. So, the above formula, sir, coupon part is not there, only the second part is there. At what rate? Whatever rate it is, discounted at your required rate of return. So, formula type if I write, fair value of zero coupon bond is equal to, you will consider the maturity value and multiply that with PV IFRR of nth period. Are you understanding, sir? This is a classic application of time value of money, nothing else. You just have to do the same time value of money chapter again with the flavor of bond in the background. That's all. IA formulas, ade PVIF, ade PVIF, nothing. Everything same to same. This is zero coupon bond. Coupon paying bond already over. Another bond I will tell you, answer you should give. Perpetual bond. Tell me, sir, what is the meaning of this? Good. This bond pays coupons forever. There will be no redemption. Maturity is not there. Maturity period is unlimited. Maturity value is 0. Which means 0, 1, 2, 3, so on, so on, so on, up to infinity. Tell me, sir, what is the fair value of the bond? What is the present value of all the coupons? Now tell, sir, you have covered time value of money now. That's all. This is a level perpetuity. Since it's a level perpetuity, fair value of the bond is equal to coupon amount divided by required return. How did we learn this in time value of money? Cash flow 1 divided by PIR. A PIR, now I am calling it as required return. In some other case, I will call it as something else. Depending on the chapter, I will change the name. But story, the skeleton is same. Clear, sir? Over? Now, we will learn some more concepts. Let's come to the first question. Look at this, sir. Mr. A is willing to purchase a 5 years rupees 1000 par value bond having a coupon rate of 9%. 1000 rupees par value, coupon is 9%, maturity is 5 years. And our Mr. A's required return is 12%. Okay, nice. How much Mr. A should pay to purchase the bond if it matures at par? How much should he pay to buy the bond? And a wording is nothing but indirectly what is he asking? Fair value, also called as intrinsic value, equilibrium value, theoretical value. How much I should pay in order to get my desired return. Correct? No? So, chalo sir. Let's work out. Question number 1. Sir, you can do it in the form of table also, formula also. Whatever is comfortable, you do. Presentation is your wish. I will do one presentation. If you want to follow the other one, please follow. That's up to you. Sir, fair value of bond, present value of future cash inflows, discounted at required return. Periods, cash inflows, PVIFA oblique PVIF at the rate of, what is this fellows required return? 12%. PV of cash inflows. I am drawing table for now. Once you get more comfortable, directly also you can do. Tell me, sir, coupon will come once every year? Every year. Like that, for how many years will it come? What is the maturity period? 5 years. So first year, second year, third year, fourth year, fifth year, 5 coupons will come. And maturity value will come at the end of 5th year. So how much is the coupon value? 1000 rupees is the par value, ma. Coupon rate is 9%. So that is rupees 90. And 5th year ending la, you will again get an amount of 1000. So now that 1 to 5 is there, that means every year ending. So that's an annuity. Apply annuity factor. Only 5 is there at 5th year ending. Apply PV factor. So do it, ma. 12% annuity factor. 3.604. 1 divided by 1.12. 1, 2, 3, 4, 5. When you do 5th year, no, first write off this. It will be easy for you. Then press GT. Multiply this 90 into 3.6048 and 567.4. 891.83. This, even if you don't fill up, nothing will happen as waste. What will you do by filling up? Multiply M plus MRC. You have GT, even more simple. This into this equal to this into this equal to GT. Directly answer will come. You want to write, you write. I don't have any issue. So this is called as what? Fair value of the bond. Now come to interpret. Sir, question is over here only. Answer is over. But there is a lot of interpretation in this. That's very, very important for us. Interpretation, sir. Let's start. If investor wants to earn 12% return, he should buy the bond at rupees 891.83. and hold it for 5 years. So what is the meaning of fair value is whatever present value future cash inflows you got, which I am calling it as fair value, rate if you are able to buy the bond, then definitely you will get your desired rate of return. That's the meaning of that. But whether this fellow will be able to buy the bond at that rate or not, that is not in his hands. Correct? No. So we'll take three scenarios now. Case 1. Actual market price of bond is equal to 891.83. That means what he did is, with his Casio calculator, this fellow computed fair value of the bond. He got it as 891.83. Immediately NSE website he opened, checked the price of this bond. Bond ka price in the market coincidentally quoted at 891.83. Surprise, shock. Sir, whatever I computed, that's exactly there in the market. Fantastic. The bond is correctly priced. The bond is correctly priced. What is the meaning of correctly priced? How much I should pay? Bond is also trading at the same price. Actual market price is equal to fair value of the bond. What is the meaning of this? Bond is correctly priced. Tell me, sir, when bond is perfectly priced, will you buy or you will not buy? You will buy. Definitely you should buy the bond. If I want to get a return of 12%, I should invest 891.83. Luckily, bond is also available in the market at 891.83 only. Why am I waiting? Buy. Now, in one angle, okay, another angle I'll tell you later on. Too much is confusing. Case 2. Actual market price of the bond is 870, or let's say 850 you take. Or tell me, sir, I am willing to pay how much for the bond actually? 891. I am mentally prepared. When I checked online, marketly bond is available only at 850. Its worth in my eyes is 891, but it's trading at 850. Will I buy or not? Yes or no? Yes. You're already prepared to pay 891, but that same bond, same future cash inflows, you are getting only at 850. Cheaply available, no? A cheaply available case, we call it as bond is underpriced. First one is called as correctly priced. This is underpriced. You should always go and buy underpriced investments. So, bond is underpriced. Therefore, we'll buy the bond. Correctly priced, we'll buy the bond. Underpriced, happily we'll buy the bond. Now, look at this. In case, sir, first case, if you buy the bond, your actual return, what you will earn, will be exactly equal to your required return. Because that's the whole concept, no, sir. If you want to earn a return of 12%, you should invest 891.83. Luckily, bond is available in the market at 891.83. I will buy. How much return will I get? 12%. Exactly you will get. But second case, you won't get 12%. You will get higher than 12%. Why higher than 12%? Cash inflows are same, but my initial investment, instead of 891, I'm just investing only 850. Returns are, there is no change. Cash inflows are same, but my initial investment is lower. Lower investment return will be higher. You understand, sir? So this is the case where your actual return will be higher than your required return. Right. Since the bond is available cheaply, nothing wrong, right? It will give the investor return, actual return higher than required return of 12%. This fellow wants 12, he won't get 12, he'll get something very high than that. That's the reason he should buy. Sir, till here did you understand? Should I confuse you for some time? I'll try to confuse. If you get confused, you learn more. If you don't get confused, then you have already learnt. Any of these two things will happen. Let's try. Focus on case 1, sir. Tell me, what is your initial investment? Which 891.83? Red or blue? Don't tell me both are same. I also know both are same. Initial investment means how much you have to spend today to buy the bond. Market price. Correct? No? How much are you spending to buy the bond? Bond is available where, sir? In your home or market? You have to pay market price only. No? How much is market price? 8. That's what, that only will become your initial investment. Agreed? Clear? Okay. Tell me, what is your PV of future cash inflows? Which one? Red or blue? Blue. What is NPV? What did we establish earlier? If NPV is 0, you will not stand there which way to go on. You have to go forward only. You have to go and buy, accept it. It's exactly that case. NPV 0 wala scenario. NPV 0 scenario interpretation was what? Actual return will be equal to required return. That's exactly the same concept. NPV concept, instead of evaluating NPV, we are converting that into fair value valuation and we are talking overpriced, underpriced. Story is same, background same, presentation different. Clear? Move on. Answer this. What is your initial investment now? Careful. 850. PV of cash inflows. 891.83. This time your NPV is 41.83 positive. NPV positive, accept or reject? Accept. Why? If you accept a positive NPV, what does it indicate? You are earning a return higher than your required return. That's exactly what I wrote. Are you understanding, sir? NPV, if you learn properly, all these are different variants of that. Time value of money, if you know, formulas are various variants of that. So as we go progress further, things slowly will sink in. Ultimate feeling will come as we cover more and more cases. Okay, continue further. Here one point I am writing. This actual return, whatever we are saying, he will earn more than 12%. No. What is the name for actual return? We studied already. Good. This actual return is IRR. And it is referred as yield in this chapter. Brackets are called it as YTM. YTM means yield to maturity. If you hold the bond till maturity date, how much return will you get? IRR computation, nothing great. We will do IRR computation again. Only thing is we don't call it as IRR, we will call it as YTM. Next thing, sir. Case 3. Actual market price of the bond is rupees 910. So actual market price 910 is seriously higher than the fair value of the bond. If actual market price is higher than fair value of the bond, tell me, sir, it correctly priced or underpriced? Overpriced. So your bond is overpriced clearly. Tell me, sir, we should buy the bond or we should not buy? We shall not buy the bond. But if you say and still go and buy the bond, what will happen? You will earn a return definitely, but that return will be less than your required return. Sir, all these are not just conclusions we are going to prove. Later on, we will have questions on YTM. You will be having questions on mixed. Then you will realize entire concept, underpricing, overpricing, what is IRR, what is YTM, what is required return. A full level clarity will come as we go further. Basics, if you are strong, SFM always is your friend. Okay. In this, another analysis is there. Third case, write that also. If investor already holds the bond, then he should sell it. Suppose, sir, you are the owner of a bond. You did not buy now, you already bought. You today, a bond ka worth is only 892 rupees, 891.83. But for some reason, the market price is 910. Market price 910 ka meaning is what you know? Some people are buying and selling the bond at 910. You know, a bond ka worth is how much? 891 only. Oh, here, what are you waiting? Go sell. Some fool will buy this bond at 910. Let him buy. I don't understand, sir. Not only you, many people like you will start selling the bonds. When people start selling the bonds, more and more sellers will enter into the market. More sellers means the supply of bond in the market is high. What will happen? Price falls. A correction naturally will come from 910 slowly. It will come down to 891.83. Are you getting it, sir? Similarly, the underpriced case you see. What is the worth of the bond? 891. But it's available at. What did you do? Today you bought the bond. You are not stupid to buy one bond. No, you will buy multiple bonds. You'll pick up as much as you can. Not only you. I also know bond valuation. I will also do. Somebody else also will do. She will also do. You will also do. When everybody does that, what will happen? More and more buyers are entering into the market. Demand increases. What will seller do? Increase the price. 850 become 860, 860 will become 875, still people will buy. 875 will become 880, 885, 889, 890, 891.8. It will stop. Some fellow will quote 895, nobody will buy. Because by then the bond is already overpriced. Are you getting it, sir? This is theory. Reality, demand supply conditions also same thing will work. But the background logic is this. Are you understanding? Sure. So this is one analysis. Now you tell me, one general thought, sir. It will be slightly confusing, but you'll understand. Case 3 is overpriced or underpriced? What is the meaning of overpriced? The bond is trading at a price higher than its actual worth of the bond. Right. Do you agree bond is trading at discount? Do you observe that the bond is trading at discount to par value? Par, premium, discount and one concept is there. Underpriced, overpriced, correctly priced is another concept. Par, premium, discount is something which is comparing bond ka market price with the coupon price, coupon amount. So not coupon amount, face value. Face value 1000. Since face value is 1000, actual price is above 1000, bond is trading at premium. Market price is exactly 1000, bond is trading par. Below 1000, bond is trading at discount. Bond trading at discount and underpriced are not same. Bond trading at par, premium, discount is a analysis which we are making looking at face value of the bond and market price of the bond. But instead of face value, if you compare the bond price with fair value, then we will not use the words discount, premium, par. We will use the word underpriced, overpriced, correctly priced. For decision making, whether to buy the bond or not. For decision making, which one is relevant? This one. What we just now discussed. That is, compare the market price of the bond with fair value and observe whether it is overpriced, underpriced or correctly priced. If you see the third case, 910, what did we write? Adi overpriced. But if you technically see, compared to face value, it is trading at discount. So the discount loans are, I will go and buy. Wrong answer, stupid people. Decision making should not be done based on par, premium, discount. Decision making should be done based on pricing. And pricing is based on fair value and market price of the bond. Are you understand? So there are two analyses. Another analysis also will come slowly. But the point here is, decision making ki you should only compare market price with fair value. Par, premium, discount is not for decision making. That is just a simple observation, that's all. Okay, this is one concept. So based on this, one more question we will do and then we'll come back. Question number 1 we are done, sir. Question number 2 is an examination question. I'll just take you through it. I'm not solving this as it is. We'll solve better questions. Read once. An 8.5% bond. What is the meaning of that line? Good. Of rupees 1000 face value, that I need not ask you and insult myself. 5-year maturity. Life is 5 years. Maturity at par. That is also nice. And yield to maturity of 10%. Has, yield to maturity is a discounting rate, has rupees 954.74 as the current market value. Okay. He is asking, calculate the price of the bond and compare it with market price, and what action should the holder of the bond take. Okay. As such, it's easy only. What is he asking? He gave you bond terms. Bond is having a life of how many years? 5 years. So next 5 years ka cash flows, you will discount it, work out the price. You got one price. How much fair value did you get? 943.17. So in order to earn your desired return of 943.17, you have to invest, in order to earn your desired rate of 10%, you should invest how much? 943.17. But actually bond is trading at 954. The bond is overpriced or underpriced or correctly priced? Overpriced. When bond is overpriced, will you buy a? No. But if you already have the bond, that's all. The bond is overpriced. Now, sir, I don't want to find a fault with the question purposely, but there is a flaw in the question. I'll tell you what is the flaw, correctly understand. They used the word yield to maturity. Yield to maturity means actual return and not required return. Okay, so this, even though the question used it as yield to maturity, their intention is not YTM. This is intention of the question is required. Sir, how can you so confidently say that their intention is required return? Sir, when I am working out fair value, I have to use only one discounting rate. What is that? Required return. Fair value versus actual market price I will compare. Then I will take a decision. Okay, sir. Fair value calculation ki you will never use actual return. You have to use only required return. That's all. Okay, another proof I will tell you. Come here. Look our case 2. Case 2, sir, tell me, what is your required return? Required return, all the 3 cases is same only. How much? 12%. But in case 2, my actual return will be higher than 12%. Why higher than 12%? The bond is cheaply available, underpriced bond. If you buy that bond, your YTM will be more than 12%. Now, for identifying fair value, I'll discount with 12%, more than 12%. Fair value, 12%. You'll never discount with YTM, no. If you want to obtain fair value, you have to discount your cash flows with which rate? Required return. The examination question, CMA final, I did not create that question. But questions of loss will be there, sir. Welcome to CMA final. Lot of loss will be there. Sir, flaw is there, no, we will learn like that only. Every question it will not be there. That's the problem. If entire concept they messed up, no. I will not teach you original thing only. But entire concept they did not mess up. Sir, which stupid will discount with YTM to get fair value, sir? That's conceptually wrong. For example, what will you do? You tell me, sir. If you are literally sitting in the exam, he is asking what should I do with this bond. You prima facie in your heart, you know. Market price question given. What I want? Fair value of the bond. For computing fair value, I need required rate and discounting rate. I enter question only one rate is there, which is 10%. That stupid is calling it as YTM. What will you do? Our required return is not there, I will not do, and you will come off, sir. You don't have a choice, sir. A question of flaw is there, what can I do for that? The reason I told I will not solve that question is that only. My hands will not come. Why, sir? Anyway, let's make one more small conceptual discussion. Easy one. Come here. Consider a bond which has cash flows like this. 1 year. It will give you coupon of 10. So fine, leave all this, just simply write cash inflow. $100. Now, required return is 10%. Tell me, sir, what is the fair value of the bond? Very easy, no? 100 divided by 1 plus 0.10. I'm not doing PVIF and all, only 1 year, sir. Directly I'm doing it off. You're getting 90.91. Tell me, interpret. What's the meaning of 90.91? Fair value interpretation, you have to tell 100 times. Don't worry. Shamelessly answer. Fair value of bond ka meaning 90.91 ka meaning is what? Tell. Actual price is 90.91. Huh? Fair value. Fair value. Fair value ka meaning is what? Good. If you want to earn a return of 10%, sir, required return ka meaning catch correctly. I want that. If you want that, you have to buy the bond only at 90.91. That's the meaning of that. Am I clear? Fantastic, mind blowing, beautiful. Now, look at this. Tell me, sir, you want happy case or sad case? Sad case. Actual market price of the bond is 86. Tell me, bond is overpriced or underpriced or correctly priced or don't know? Underpriced. Pakka? Okay, if you say so. So bond is underpriced. Tell me, ma, bond is underpriced. Buy or sell? Buy. Okay, if you buy the bond, your actual return will be definitely higher than your required return. What is your required return? 10%. Your actual return definitely will be higher than required return. Sir, how to compute actual return, sir? Array, sir, how to compute actual return? You can easily work out because luckily I gave you a 1 year bond. 86 rupees if you invest today, you will get 100 rupees cash inflow a year later. Can you work out return? Only two cash flows are there. Sir, how to work out? So we forgot. Array sir, how to work out IRR between these two? Two cash flows only. Present value, future value formula. So tell me present value, future value formula. I told you one formula, no? IRR oblique YTM, when only 1 point inflow, 1 point outflow is there. Open your time value of money concept book, last page. See and do. Nth root of inflow by outflow minus 1. Why to trouble you with formulas? Leave it. I'll keep it very easy. $86 का future value sir is equal to 100. R is equal to how much? 100 by 86 minus 1. .1628 or 16.28%. This 16.28% is your actual return. Actually, I could have worked out like this. %, same answer will come. Why I did not work out like that is, if I do like that, you will ask me that it is simple return. That's why it did not work. Simple return, compound return, both will be same because the life of the bond is only 1 year. Reinvestment time may not there, no. That's the reason both will be same. But I did not wanted to use that formula, leave it. Now my point here is this. Your required return is 10, but your actual return is 16.28. Now, what will happen if I take the bond future cash flow of rupees 100 and discount it to today at 16.28%? What will happen? Sir, what will we know, sir? Try 100 rupees divided by 1 plus 0.1628. $85.99999. What is 86? That I know. What is 86? That is your actual market price of the bond. So 86 is your actual market price of the bond. Suppose ide cash inflow you take and discount with 10%, which is your required return. We already did know, of course. If you want again, I'll do 100 divided by 1 plus 0.10. 90.91. This one is called as fair value of the bond. From this, what you have to conclude is, if discounting rate is actual return, which is also called as YTM, price represents actual market price of the bond. If your discounting rate is required return, it will give you the fair value of the bond. So you should be careful with all the simple concepts, but very small concepts, very powerful observations. Who is your discounting rate? Sir, my discounting rate is RR. Your present value is called as a fair value. Discounting rate is YTM, actual return, actual price. Sir, how to remember? Simple. Actual return, actual price. Required return, fair value. Just have one small thought in your mind. Actual return, somebody would have computed actual return. Tell me, sir, actual return computation law, market price of the bond is considered or not considered? Considered. If 16.28, how did you get, sir? Did you consider 86? No. So, a 16.28 calculation, market price is already there, actual market price. So, when you discount 100 with 16.28, automatically you will get the market price of the bond, not the fair value of the bond. I told you why that question is flawed is for the same reason. That fellow discounted with YTM. YTM is actual return. Actual return, though, if you discount, you will get market price only. But if you see in that question, when you discounted with 10%, that fellow did not get market price. He got 943. Are you understanding, sir? If that was correct to YTM, then answer should have been how much? 954.74. But we got 943.17. That is a proof that that is not YTM. That is required return. Are you understanding, ma'am? What discounting rate you use, depending on that, a price one tag I will give, either fair value or actual price. Clear? All good? Sure, pakka. Okay. A coupon rate, coupon amount, par premium discount, that we will talk in the next session. Another case you do. Do case number 3. If you do this, then you are okay, on par with me. You are understanding. And I will understand. Please read. ACFA Industries is planning to issue a debenture series on the following terms. So there is a company is issuing bonds, sir. Face value 100. Term of maturity is 10 years. Yearly coupon rate. Year 1 to 4, 9% they will pay coupon. 5, 6, 7, 8. Next 4 years they will pay at the rate of 10% coupon. Last 2 years they will pay 14%. What is not same every year? Coupon rate is not same. Every year they are having a different coupon rate. The current market rate on similar debentures is 15% per annum. Tell me, sir, what is the meaning of this? Current market rate on similar debentures is 15% per annum. Ka meaning is, sir, in the see, you are stupid. You are planning like this. But ordinarily, people issue bonds at the rate of 15%. Indirectly is hinting that this is present required return in the market. Present required return in the market is how much? 15%. Sir, if you discount with 15%, what will happen? All the bond cash flows, if you discount with 15%, you will get the fair value of the bond. If you issue the bond at that price only, that only will become the actual price of the bond also. And investor also will get how much return? 15%. Correct? But you see this generous company. The company proposes to price the issue in such a manner that it can yield 16% rate of return to the investors. What is the meaning of that? What is the meaning of that? I know, I did my research. I observed that public are expecting a return of 15. Tomorrow if I offer the bond with a coupon rate of 10% or 12%, public may not buy the bond. Issue fails. I will not get my money. Okay, sir, let us price the bond in such a way that they will get 15% return. Who knows? If 15 is my research. Ultimately, on the issue date, if the public expects more than that, still my issue will be failure. I don't want to take risk. I want to issue the bonds in such a way that whoever buys a bond, they will get a return of 16%. Okay, fine. The company also proposes to redeem the debentures at 5% premium on maturity. Okay. Question is this. Determine the issue price. You tell me, sir, issue price is theoretical fair value, real price? Issue price is market price or theoretical number? Issue price means if I quote something as issue price, what will investor do? He will pay me that money, no? So that is going to become the market price. So indirectly what is he asking? Tell me the market price. If you want market price as your answer, your discounting rate should be actual return, required return, actual return. So ఈ sum లో both the returns are given to confuse you. You should pick up the correct return. 15% is recovered return. If you discount to 15%, you will get fair value. Investor is willing to pay that much, but you want to tempt him more by giving him more return. And how much return do you want to give him? 16%. So what will you do? You'll discount all the bond cash flows with 16%. You will get one actual price. Issue the bond at that rate. Investor point of view, what he will do? He will discount all the cash flows with 15%. And then he compares fair value versus actual price. He will observe that the bond is underpriced. If I buy this bond, I will get 16%. He'll tempt and buy the bond. My bonds will be sold. I'll receive the money. This is the company ka plan. Are you getting it, sir? Now if you watch this story, question is from company's point of view only, but entire analysis is from investor's point of view. Because whether investor will buy the bond or not, company will not know. Company can only issue the bond. But how to make the investor buy the bond? To give him more return. Give him more return, he will buy. He wants 15 only, but I will give him 16. If I use a higher discounting rate, present value will fall, price, actual price will be lower, that fellow will get tempted and buy the bond. Clear? Now he is asking that. So let's try to work out this. Question number 3 ka answer please write, ma'am. To compute the actual issue price of the bond, discount the bond future cash flows at actual return oblique YTM of 16%. What will happen if you use 15%? You won't get issue price. You will get theoretical fair price. Fair price is theory. Reality is actual market price. If they both are same, no problem. They are not same, then you will take a decision based on underpricing or overpricing. So let's come here. Here. Cash inflows. PVIFA oblique PVIF at the rate of 16%. Last column, PV of cash inflows. First 4 years, this fellow has got one coupon amount. Next 4 years, another coupon amount. Next 2 years, another coupon amount. And 10th year ending is having a maturity value. Now, first 2 years, what's the coupon? 9%. Face value is how much? 100. 100 into 9%. So that's 9 rupees, sir. Okay. After that, 10 and 14. And towards the end of 10th year, that fellow says he'll redeem the bonds at premium on maturity 5%. So how much will he pay, sir? 105 he will pay. Now, you will tell me annuity factors correctly. $2.7982. Okay. You told me 4 years annuity factor. Now what I want? 5 to 8 annuity factor. That is called as mid annuity factor. Correct, no sir, mid annuity factor. How to work out mid annuity factor? 1 divided by 1.16. First year, second year, third year, fourth year. I don't want these 4. Is equal to 5th year M plus, 6th year M plus, 7th year M plus, 8th year M plus MRC. 1.5454. Next. I want 9 to 10 का annuity factor అంటే 9th year and 10th year का PV factors का summation 1 divided by 1.16 first year, second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year I don't want. Now next year I want 9th year is equal to M plus, one more is equal to M plus MRC. 0.56 8. No, 56797, so that's 568. You're getting different answer, huh? I'm sorry, sir. Then I might have pressed one thing extra. 1.16. 1, 2, 3, 4, 5, 6, 7. PO. Correct, you are right. 0.4896. Okay, sometimes I do testing like that. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Tell me last. Why is this calculator giving me wrong answers? 1, 2, 3, 4, 5, 8, 9, 10. Okay, now it's giving correct answer. 0.2267. Last one is PV factor, sir. First one is annuity factor. Middle two are mid annuity factors. For that you have to use M plus and get it. Multiply all this and tell me the final number. Well, sir, 71.26, sir. 2, 9 you got, huh? Okay, wait. It's okay, don't fight for chiller, leave it. Well. Sir, if you are an investor, what will you do? If the company is thinking, company will do this and they will issue. If you are an investor, how you will think? Underpriced or overpriced, how will you know? You will take the same cash flows, but instead of 16, you will discount it with 15% required return. Since you are using a lower discounting rate, what will happen to present value? It will be higher. So here I got 71, let's say you got some 75. So investor will be thinking, I will pay 75 and buy the bond. Company issues the bond at 71. The bond is underpriced. If you buy an underpriced bond, you will get a return more than your required return. Investor will buy the bond or not? Yes, he will buy the bond. And therefore the company will get the money for whatever purpose they are getting. They are raising the money for. Bonds will be sold. The company ka plan. Are you getting it, sir? Right. Question number 5 you do, and we'll close it for today's session or class. 5. Fourth one is your study material question. Fifth one is also similar question only, but fifth one you do. A bond with 7.5% coupon interest. Face value 10,000. Maturity is 2 years. Presently yielding 6%. Means it is ATM. Interest is payable half yearly. Compute market price. See, he is not asking you compute fair value of the bond. Are directly, openly, shamelessly asking work out market price. So discounting rate should be what? YTM. Did they give you YTM? Yes. Actual return is given. Actual return, though, if you discount cash flows, what will you get? Actual price only you will get. That's all. Only twist is, here coupons are payable half yearly. If coupons are payable half yearly, tell me, sir, your each period is how many months? Each period is how many months? 6 months. Every 6 months once you will pay interest. In a span of 2 years, how many 6 months are there? 4. So you will have how many periods now? 4 periods. That's all. Right. Question number 5. Each interest period is equal to 6 months. Coupon amount is equal to, what is the par value given this fellow? 10,000 into 7.5%. Okay, 10,000 into 7.5% into 6 by 12. Much? 375. In a maturity period of 2 years, there are how many periods? 4 periods of 6 months each. Next one. YTM is equal to 6% per annum. Periodic YTM is equal to 6% into 6 by 12. So since it's a semi-annual bond, you see where all adjustments came. Adjustment was there in coupon. Adjustment was there in number of periods. Adjustment is there in discounting rate as well. Everything you have to convert into half yearly basis. Life half yearly basis, discounting rate half yearly basis, cash flow half yearly basis. Then you do the sum normal. That's the reason e columns I am putting the heading periods. Coincidentally, maybe here, I don't know, but it is not. So periods, cash inflows, PVIFA oblique PVIF at the rate of 3%. PV of cash inflows. Your next 2 years ki, or next 4 periods ki, your coupon amount is same. I can confidently write 1 to 4. Coupon amount is 375. Fourth period ending la par value 10,000. Tell me, sir, 3% annuity factor for 4 years. 1 divided by 1.03. First, let us write this. Otherwise, again, you have to do. So guys, this is your market price of the bond. Is clear? Sure, pakka. Well, sir, what you do is revise all this, revise time value of money also, revise this also, and then tomorrow we'll play more. See you guys.